Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Mark Nash, Head of Fixed Income for Merian Global Investors. Hi Mark.
Good morning, Emma.
So it has been quite a challenging year across all asset classes. Why should we be optimistic heading into 2019 for bonds?
I think we should, and I think it's not just the bond market, it's the general sort of risk environment, which I do think will improve in 2019. Essentially, the story of this year is you've had global monetary tightening at a time when generally global growth has been falling, and so we've seen the impact across asset markets. It's been really bad. Now, literally 96% of fixed income and equity indices have actually posted negative returns. But going forward, what we see from now is finally the Federal Reserve starting to sort of ease up on their tightening, and the reason for that is it's now the sort of tightening impact that they've impacted on the world is now coming back to the US shores. You're starting to see credit indices start to widen. You're starting to see a little bit of a slowdown in the US. We're starting to see equity markets come off. And the Fed will take note of this and start to sort of ease back on their gradual tightening program. You know, they're still going to do probably 2 or 3 more hikes, but then that'll be it. And then markets can get a little bit more relaxed about the risk outlook on the back of that. And emerging markets then should start to bounce back. Equity markets in Europe, also risk markets in fixed income land in Europe should have a better time next year.
Because the Fed seems to be the thing that we're all worried about. Again, across asset classes, if the rates rise too quickly, it has impact for bonds and for equities. Inflation is one of the things that could push it higher, but it sounds like you're not too concerned about that.
Not really. You know, everyone's talking now about the increase in wages that we are seeing, which is absolutely a good thing, you know, given the political backdrop we're seeing in the West. But those wage rises are pretty low at the moment. You know, they're going up, but very gradually. And if wages are rising less than productivity, it doesn't mean that inflation is about to kick off in a big way. If inflation is going to be sort of going up, but very gently, then central banks can continue to raise rates, but also very gradually, and that should be positive for asset markets. Now, I do think with Jerome Powell, he's a different type of central banker. He's very pragmatic. He's going to recognise the fact that there is no inflation problem in the US, and therefore his rate rising program can be pretty gradual. And the last thing he wants to do is knock these wage rises on the head, because wage rises are a good thing, and all these authorities actually do enjoy the fact that they're happening.
So far more positive it sounds, but there must be particular pockets of opportunity that you like going into the next year. Where are you seeing those?
Absolutely. For example, we really like subordinated bank financials. Now, bank equities and bank bonds have had a really bad time this year in Europe, especially because we've had this monetary tightening, mostly on the back of the Fed, but also the ECB sort of reining in their tightening program, and also, you know, a slumping growth pretty much all year, essentially on the back of that monetary tightening, and also the slowdown that we're seeing in China. We see the broader sort of growth backdrop in the West as pretty good. You know, it is broad-based. Investment spending, you know, is happening. Domestic demand levels, you know, are picking up in the US and also Europe. Therefore, it's a good backdrop for when you get some stability in the Chinese situation, which we believe should be happening in due course. Then the growth outlook looks good, and these sort of risk markets, these bank bonds, can start to sort of do a little bit better.
Mark, thank you very much.
Thank you, Emma.
This is Emma Wall for Morningstar. Thank you for watching.